$41. That is what a large bank is permitted to charge you for being 1 day late on a credit card payment. Not 30 days late, 1 day. And if it happens a second time inside the same year, that is the amount for the second one, sitting on top of the first. 2 years ago, you were told that number was becoming $8. Every outlet carried it. $10 billion a year coming back out of the banks and into ordinary accounts. It never happened. Not for 1 day, not for one customer, not once. And that is only the first of 4 things sitting between you and the statement that arrives in your mailbox this month. The second is a protection almost everybody believes is federal law and is not. The third has already lowered the credit scores of people who did nothing at all differently from the year before. And the fourth is something you may have been carefully saving up for years that can be reduced to nothing without anybody asking you. Here is what connects all 4. And once you see it, you will not be able to stop seeing it. Not one of these 4 protections is legally binding on anybody. That is the thread. Every single one of them exists because a company chose it, or an agency proposed it, or a court permitted it. Not one of them is a law that somebody would be breaking if they took it away tomorrow. They can each be withdrawn without your consent, without notice, and without anybody doing anything wrong. Which sounds bleak, and it is not. And I want to say why before we go any further. Because there are protections in this that are absolutely binding, and they are the ones you build yourself. A setting you switch on, a phone call you make, a report you pull. Those cannot be taken away by a court ruling or a policy change. And by the end of this, you will have 4 of them. My name is Kevin. I read the fine print so you do not have to sit with it. Every week I take one of these apart in plain English with the actual move attached, because knowing a rule changed has never once put $1 back in anybody's account. The setting does. The phone call does. If that is useful, subscribe and turn the bell on, because the third item in this video is the one nobody is warning older people about, and it works quietly. So, the late fee. Let me give you the whole story, because the ending is not where most people think it is. A federal rule was finalized in March of 2024 that would have capped late fees at $8 for the largest credit card issuers, meaning those with more than 1 million open accounts. The reasoning was that the existing amounts, $30 for a first late payment and $41 for any after that, were far above what it actually costs a bank to process a late payment, and were functioning as a revenue line rather than a penalty. The estimate was $10 billion a year. Within days, the Chamber of Commerce, the American Bankers Association, and several other trade groups sued in federal court in Texas. And here is where it gets genuinely unusual, and I want you to understand it because it is not what people assume happened. The rule was not simply struck down by a judge over the objection of the government. What happened is that after the change in administration, the agency that wrote the rule switched sides. It filed a joint motion, together with the industry groups that were suing it, asking the court to vacate its own rule. In that motion, the agency agreed with the plaintiffs that its own rule had violated the law. The judge granted it on the 15th of April, 2025. So the $8 cap is not delayed, and it is not under appeal. It was vacated by agreement, and the agency that created it conceded the case. Now, I am going to give you both sides of that properly, because this is a live political argument, and I have people watching who sit on every side of it. The legal argument that won is not frivolous. There is a law from 2009, the Card Act, which says card issuers may charge penalty fees that are reasonable and proportional to the violation. The court held that dropping the amount to $8 did not allow issuers to actually impose penalty fees in any meaningful sense, and therefore conflicted with the statute Congress had written. Whatever you think of the fees, that is a real legal question about whether an agency exceeded what Congress authorized it to do. The argument on the other side is equally real. The gap between what a late payment costs a bank to handle and what it is charged for is enormous. And that gap falls hardest on people who are late because the money was not there, rather than because they forgot. I am not going to tell you which of those to hold. What I will tell you is the practical fact. And the practical fact is that at most large banks, your late fee today is $30 for the first one and $41 after that. Now, what happened last month? Because this is genuinely new. In early July, multiple financial outlets reported that the same agency has submitted a request for information about credit card late fees to the White House office that reviews these things. A request for information is often the first formal step before a new rulemaking begins. which is a striking turn, given that the same agency spent last year working to kill its own rule on this exact subject. Be careful about what that means. It is not a rule, it is not a proposal, it is a request for information. And analysts who follow this closely are openly skeptical that anything binding comes out of it, given how the last attempt ended in court. So the honest status is this. Your fee is $30 to $41 today. Something may be underway. Nothing has changed, and you should not arrange a single thing in your life around the possibility that it will. Wilburn is 76, and he has never missed a payment on anything in his life. He is quite proud of that, and he has earned it. Last October, he was in hospital for 11 days for a hip he had been putting off. His daughter brought him the mail. Nobody thought about the card because there was nothing on it. $70 for a prescription and a tank of petrol. $41 in fees on a $70 balance. And then interest began, because paying late also ends the grace period on a card most months he had cleared in full. The fee was more than half of what he had actually spent. And here's the part that stayed with me. When I told him he could have called and asked them to remove it, he said, "I did not know you were allowed to ask." That sentence is the reason the quiet rules exists, not clever strategy. The short list of things you are simply allowed to ask for, written plainly and in large print, so that a hospital stay costs you a hospital stay, and not a hospital stay plus a fee, plus interest, plus a year of a higher balance. Reading it on an ordinary afternoon costs you nothing at all. Finding out about it afterward from a stranger is how most people learn it. It is at kevinexplains.shop. The link is in the description below and in the pinned comment at the top. And if you are watching this on your television, there is a code on the screen you can point your phone camera at. 7-day guarantee, no argument. If it does not hand you something you did not already have, send it back. So let me give you the two things that actually protect you here, because these are binding in the only way that matters, which is that nobody can vote them away. The first is automatic minimum payment, not automatic full balance, the minimum. Go into your account online or telephone the number on the back of the card and set the automatic payment to the minimum amount due on every card you hold. It takes a few minutes per card. Understand what that does and does not do. It does not stop interest. If you carry a balance, you still pay interest on it. What it does is make it structurally impossible to be charged a late fee, because the minimum goes out on its own whether you are traveling, unwell, distracted, or in hospital for 11 days. And you can still pay the full balance manually the way you always have. The automatic minimum sits underneath as a floor. Most months it never triggers because you have already paid. The 1 month it matters, it saves you $41 and the loss of your grace period. The second is the phone call, and it works far more often than anybody expects. If you are charged a late fee, ring the number on the back of the card and ask them to remove it. That is the whole request. Most major issuers will waive a first late fee on an account with a clean history, and a great many will do it on a long-standing account even when it is not the first. You do not need a story, and you do not need to be upset. The words are simply, "I have had this card a long time and I have not been late before. Would you remove that fee for me?" The person answering usually has the authority to do it without asking anybody. The reason this works is not generosity. It is that a customer who has paid on time for 15 years is worth vastly more than $41, and the person on the phone knows it. Almost nobody tries. Two things that make it work better, and neither of them is a trick. The first is when you call. Ring within a few days of the fee appearing rather than waiting for the next statement. A fee that is still sitting in current activity is easier for the person on the phone to reverse than one that has already closed into a prior statement and had interest calculated on top of it. The second is what to do if the first person says no. Ask, politely, whether a supervisor is able to review it, not angrily and not as a threat. The authority to waive a fee sits at different levels at different institutions, and the person who answers first does not always hold it. A calm second ask succeeds surprisingly often, and if the answer is still no, you have lost 4 minutes. And one thing not to do. Do not close the card in frustration. Closing a long-held card removes its age from your credit history and reduces your total available credit, which can lower your score on both counts. A card you have had for 20 years is worth far more sitting open and unused than it is worth as a gesture. Now the second item, and this is the one where the gap between what people believe and what is actually true is doing real damage. Medical debt on your credit report. You have very likely seen headlines saying medical debt is being removed from credit reports. That is partly true, and the part that is not true is costing people. Here is what actually exists. The three credit bureaus, Equifax, Experian, and TransUnion, adopted voluntary policies between 2022 and 2023. Under them, paid medical collections come off entirely, regardless of the amount. Medical collections with an original balance under $500 do not appear at all, paid or unpaid. And a medical collection cannot appear on your report until at least 12 months after the first missed payment. Those three changes removed roughly 70% of medical collection entries from credit files across the country. That is enormous, and it is real. Now look carefully at what is not on that list. An unpaid medical collection with an original balance above $500, that is more than 12 months old, can still appear on your credit report and can still lower your score. Estimates put that at somewhere around 15 million Americans. And here's the part that matters most. Those three protections are not law. They are policies the bureaus adopted voluntarily and continue by choice. There was a federal rule finalized in January of 2025 that would have banned medical debt from credit reports entirely and barred lenders from using it in decisions. It was challenged in federal court in Texas, and in July of 2025 it was vacated on the finding that the agency had exceeded the authority Congress gave it under the Fair Credit Reporting Act. So there is no federal regulation banning medical debt from credit reports. What protects you is a decision three companies made and could unmake. Now, two pieces of genuinely good news that almost nobody mentions, and the first one may apply directly to you. 15 states have passed their own laws restricting or banning medical debt on credit reports. State law is law. If you live in one of those states, your protection does not depend on any bureau's goodwill, and it did not disappear when that federal rule was vacated. That is worth 10 minutes of your time to find out because it changes what you can insist on. On those 15 states, one practical note. The list has been growing, states have been adding themselves year by year, and the protections differ. Some ban medical debt from credit reports outright. Others restrict how and when it can be reported, or bar collectors from furnishing it at all. So the question to ask is specific rather than general. Search for your own state's name together with the words Medical Debt Credit Reporting Law. Or ring your state attorney general's Consumer Protection Office, which exists in every state and answers questions like this at no cost. And if you are in one of those states and a medical collection is on your report anyway, that is not just something to be disappointed about. That is a violation of your state's law, and your state attorney general is the place that complaint goes. The second is about scoring. The newer models, FICO 9, FICO 10, and Vantage Score 4, ignore paid medical collections completely and weigh unpaid medical collections considerably less than other kinds of collections. Older models do not. Which lender uses which model is out of your hands, but the direction is moving in your favor. There is one more thing about that 12-month window, and I think it is the single most valuable protection still standing in this whole area. 12 months is a long time. A medical bill that goes to collections today cannot appear on your credit report for a full year. That is not a grace period in the sense of hoping nobody notices. It is a working window in which you can do something, and there is a great deal you can do inside it. You can request an itemized bill, which hospitals must provide and which catches errors at a rate that would astonish you. You can ask whether the charge should have gone to insurance and did not. You can apply for the hospital's financial assistance program, which nonprofit hospitals are required to have and which very few people know to ask for by name. And you can negotiate the amount directly with the collector in writing. Any one of those resolving means the collection never appears at all. So the practical instruction is this. The moment a medical bill goes to collections, that is not the moment to be embarrassed and put it in a drawer. That is the start of a 12-month clock during which the thing is still fixable and invisible. The people it damages are almost always the ones who did not know the clock existed. Nadene is 69, and she found out about hers from a car dealership. Her rate came back higher than she expected on a modest used car, and the finance manager, who was decent about it, turned the screen round and showed her a medical collection from a hospital stay 4 years earlier. She had paid that bill, she was certain of it, and she was right, and she had the record at home in a folder. What had happened is that the account was reported to one bureau and never updated after payment. Her other two reports were clean. She had never looked at any of them because nothing in her life had ever suggested she needed to. What she asked me afterward is the question I get most on this subject. How was I supposed to know? And the honest answer is that she was not, under the system as it works. Nobody writes to tell you that a company failed to update a record about you. There is no notification. The only mechanism that exists for finding out is you going and looking, on purpose, at something you have no particular reason to suspect is wrong. That is a strange arrangement when you think about it plainly. A file is kept about you. It affects the price of nearly everything you borrow, and the entire responsibility for its accuracy sits with the person least equipped to audit it. It took one dispute letter and about 5 weeks, and it came off. 5 weeks, one letter, and it had been sitting there for 4 years, silently costing her money on every rate she was ever quoted. That is exactly what the guide is built to prevent. Not complicated strategy. The 3 or 4 things worth checking once a year, in plain English and large type, so that a mistake somebody else made gets caught by you in an afternoon, rather than by a stranger with a computer screen at the worst possible moment. Same place, kevinexplains.shop. The link is in the description and the pinned comment, and the code is on your screen if you are watching this on the television. 7-day guarantee, every single time. A woman of 69, in a dealership, being shown a bill she had already paid. So here is how you check, and it is free, and it is the highest value hour in this entire video. Go to annualcreditreport.com. Say the name out loud to yourself, because that is the only site authorized under federal law to give you your reports for free. Everything else advertising free credit reports is selling something. Pull all 3. Equifax, Experian, TransUnion. This matters enormously, and Nadene is the reason. An error very often sits on one bureau and not the others, and each one must be disputed separately. Checking one and assuming the rest are fine is the most common mistake people make. You can now pull all 3 free every week, and that is permanent. When you have them, go to the collections section and look for 4 specific things. Any medical collection under $500, which should not be there at all. Any medical collection you have already paid, which should not be there either. Any medical collection less than 12 months old, and any account where the date of the original missed payment looks later than when you actually missed it, because a debt that has been redated stays on your report longer than it legally should. If you find any of those, dispute it with that bureau. Disputes are free, they must be investigated, and the investigation has a deadline of 30 days. And if you look at your reports and cannot work out whether something is wrong or simply unflattering, email me. The address is on your screen and in the description below. I read every one that comes in. Now the 3rd item. And this one is genuinely a trap, because the product was sold on the exact opposite promise. Buy now, pay later. You have seen these at checkout, online and increasingly in shops. Split this into 4 payments, no interest. The names are Affirm, Klarna, Afterpay, and the Pay Later option inside PayPal. For years, one of the loudest selling points was that these were invisible to the credit bureaus. That was accurate. A person could open several of them and none of it touched a credit file. That is over. Affirm began voluntarily reporting to Experian and TransUnion. Klarna began reporting to TransUnion, and the scoring company itself has built 2 new models specifically designed to include this activity. So the thing that was sold as leaving no trace now leaves a trace. Why this matters more for the people watching this than for anybody else, and this is the part nobody is saying. Somebody in their 30s with a thin file may actually benefit. On-time payments become positive history where they had none. That is a fair argument, and I will not pretend otherwise. But consider somebody who has spent 45 years building a score in the high 700s or above. That score rests on a long average account age, a spotless payment record, and very few new accounts. Now open 3 of these in a single autumn, buying presents for grandchildren. Each one can be a new account. New accounts lower your average account age. Several opened close together looks like a burst of new borrowing. And a payment missed by a fortnight on a purchase you had already forgotten about can now be reported as a delinquency on a file that has never had one. None of that is a punishment for irresponsibility. Every one of those purchases might be paid in full and on time. It is a scoring effect landing on the profile that has the most to lose from it. And there is no notice. Nothing at the checkout says this may appear on your credit report. You are agreeing to it in terms nobody reads, in a shop, on a phone, buying a coat. So here is the rule, and it is narrow rather than alarmist. If you expect to apply for anything in the next year, a mortgage, a refinance, a home equity loan, a car loan, or in some places even a new insurance policy, do not open new buy now, pay later accounts during that window. Use the card you already have. If you are not applying for anything, this matters far less, and I am not going to tell you to be frightened of a payment plan on a sofa. Just know that it is no longer invisible, and pay it exactly the way you would pay a card. There are two more things about these worth knowing because they are the parts that surprise people. The first is what happens if something goes wrong with the purchase. When you pay with a credit card and the item never arrives, or arrives broken, or the company will not refund you, you have a formal right to dispute the charge with your card issuer and have it investigated. That right comes from federal law, and it is one of the strongest consumer protections that exists. A buy now, pay later plan is not a credit card and does not carry the same protection in the same way. Some providers have their own dispute process, and the quality of it varies enormously. So on a purchase where something could go wrong, a large item, a piece of furniture, anything being delivered, the card in your pocket is meaningfully safer than the payment plan at the checkout. The second is what happens when the payment fails. These plans typically pull automatically from a debit card or a bank account. If the money is not there on the day, you can trigger a failed payment fee from the provider, and separately, an overdraft or insufficient funds charge from your own bank on the same transaction. Two charges from two companies for one shortfall. On a fixed income where the deposit arrives on a set day of the month, that timing question matters more than the interest rate ever will. Look at when each installment is scheduled and compare it to when your money actually arrives. Ellery is 72, and he has been saving airline miles for 11 years. The plan was always the same. His son is in another country, and one day, when it was the right moment, there would be enough for the whole family to go together. He has a number in his head that he has been working toward. What he did not know is what the card agreement actually says, which is that points and miles are a benefit the issuer may modify, devalue, or discontinue, and that a devaluation does not take a single point away from you. It simply changes how many of them a seat costs. That happens regularly. It has happened repeatedly at every major program. Nobody is required to warn you. Nobody has to compensate you, and there is no legal claim afterward because the agreement you signed says exactly this. Which brings me to the fourth item, and it is the shortest. There is a bill that has been introduced in Congress several times and continues to be debated, which would require the large card networks to allow merchants to route transactions over a competing network. Something similar was done with debit cards years ago. The banks and networks argue that if it passes, the interchange fees that fund rewards programs fall, and they would respond by cutting back or eliminating cash back and miles. Supporters argue merchants would save enormously, and that some of that reaches consumers as lower prices, and that the rewards warning is a scare tactic. Both sides have a case. The bill is not law and may never be. But here is the thing, and it is the reason this belongs in a video about protections that are not binding. Whether that bill ever passes is almost beside the point. Your points can be devalued tomorrow morning regardless. It is written into the agreement. It requires no legislation, no court, and no notice. There is one more feature of these programs that catches people, and it is worth 30 seconds because it is entirely avoidable. Many programs will cancel your points if the account closes. If you close a card or the issuer closes it for inactivity, the balance attached to it can simply disappear. And people close cards for perfectly sensible reasons: an annual fee they no longer want to pay, simplifying things, tidying up after a spouse dies, without ever thinking about the balance sitting in it. So if you are closing a card, spend the points first, or move them somewhere they survive if the program allows it. Do that before the call, not after, because after is too late and there is generally no appeal. So the practical position is simple. Points you have already earned are worth using rather than hoarding indefinitely for a perfect moment. A trip taken at a slightly worse redemption rate is worth infinitely more than a better rate you were waiting for when the program changed. If there is something you have been saving them for, and it is roughly possible now, book it. Before I give you my read on all of this, one small thing about disputes, because it decides whether yours works. When you dispute something, be specific about what is wrong rather than saying the entry should not be there. This account was paid in full on this date, and here is the receipt. This balance was under $500 originally. This collection is only 4 months old. A specific factual claim with a document attached gets a different result from a general objection, because the investigation is a comparison between what you said and what the furnisher says, and specifics win comparisons. Keep a copy of what you sent and the date you sent it. If the same incorrect entry reappears later, which does happen, having the original dispute and its resolution in a folder turns a second fight into a 2-minute phone call. And dispute with the Bureau rather than only with the collector. Both is better. But the Bureau is the one operating under the 30-day deadline. So here is where I come out on all four, and you may see it differently. I do not think there is anything sinister here. Nobody is hiding any of this. All four of these are described accurately in documents that are publicly available and that no ordinary person is ever going to read. What strikes me is the pattern in how you learned about each one. You heard about the $8 cap loudly when it was proposed. You almost certainly did not hear when it was vacated by agreement. You heard that medical debt was coming off credit reports. You did not hear that the federal rule was struck down and what remains is voluntary. You heard that buy now, pay later does not touch your credit. You have not heard that this changed. In every case, the encouraging version traveled and the correction did not. That is not a conspiracy either. Good news is simply more interesting to repeat than a court vacating something on a Tuesday. But the effect on you is the same as if somebody had arranged it. You are walking around with a picture of your own protections that was accurate 2 years ago. And on the fees themselves, my view is narrow, and I think most people hold it whatever else they believe. A fee should have some relationship to what the thing costs. Whether an agency had the legal authority to impose that particular number is a fair question that a court has now answered. But $41 for a payment arriving 1 day late on a balance of $70 from a man in a hospital bed is difficult to describe as proportional to anything. So, 4 things. Most of them fit in one sitting. 1. Set automatic minimum payment on every card you hold, not the full balance, the minimum. It is the only thing that makes a late fee structurally impossible, and it takes a few minutes per card. 2. If you get a late fee, ring the number on the back of the card and ask for it to be removed. 1 sentence, no story required. It works far more often than people believe and costs nothing to try. 3. Pull all 3 reports at annualcreditreport.com. Look for medical collections under $500, ones you have already paid, ones under 12 months old, and any date that looks later than it should. Dispute anything wrong, free, 30-day deadline. And find out whether your state is one of the 15 with its own law. 4. If you are applying for any loan in the next year, do not open new buy now, pay later accounts. And if you are sitting on a pile of points saved for a perfect moment, use them. Wilburn lost more in fees than he had spent on the card because nobody had told him he was allowed to ask. Nadene paid a higher rate on everything for 4 years because of a bill she had already paid, sitting on 1 report out of 3. And Ellery has been saving toward a number that somebody else can change on a Tuesday morning without telling him. Every one of those 3 was careful with money, careful their whole lives. They were simply working from a picture of the rules that had quietly stopped being accurate. And that is the whole of it, really. Not one of these 4 things asks you to understand credit scoring, or follow legislation, or hold an opinion about any of it. Every one of them is a small, dull action that takes minutes and then holds regardless of what any court, agency, or company decides next. So go and update your picture. 1 setting, 1 phone call, 3 reports, 1 honest look at what you have been saving. It is 1 quiet morning at a kitchen table, and every single one of those 4 is a protection nobody can vote away from you. I am Kevin. Thanks for watching. Do not forget to check the quiet rules at kevinexplains.shop.